Are you struggling with student loan debt? You're not alone. Meet John and Sarah. John, a fresh-faced physician, is grappling with a mountain of debt from medical school, landing him with a high debt-to-income ratio. On the other hand, we have Sarah. She's an elementary school teacher with her own share of loans, yet her debt-to-income ratio is considerably lower. Both John and Sarah are standing on the precipice, looking into a future clouded by the burden of loan repayment. They're considering their options, trying to find the best path forward. From the outside, their situations might seem different, but they share a common thread: the weight of student loan debt. And they're not the only ones. Thousands are in the same boat, searching for a lifeline. Let's dive into how public student loan forgiveness could be a game changer for both of them. Public Student Loan Forgiveness, or PSLF, is a potential lifeline for those like John and Sarah. Let's start with the basics. PSLF is a federal program designed to forgive the remaining student loan balance for borrowers who have made 120 qualifying payments while working full-time for a qualifying employer, typically a government or nonprofit organization. Now imagine John. He's a physician with a high debt-to-income ratio, burdened by hefty student loans from medical school. And then there's Sarah, a teacher with a relatively low debt-to-income ratio, but still struggling to pay off her student loans. Both of them could benefit from PSLF, but how? Well, for starters, they need to make sure they're enrolled in an income-driven repayment plan, which caps their monthly payments at a percentage of their discretionary income. This is a crucial step, as only payments made under such plans count towards the 120 required for forgiveness. But it's not just about making payments. John and Sarah need to certify their employment annually to ensure that their payments are indeed qualifying towards forgiveness. This is a step many borrowers overlook, leading to disappointment when they apply for forgiveness and find they don't qualify. Now let's talk about the pros and cons. The biggest pro, of course, is the potential for a significant portion of your loan to be forgiven, tax-free. This could mean tens of thousands or even hundreds of thousands of dollars saved for individuals like John and Sarah. But there's a catch: not all loans or repayment plans qualify. And the requirement to work full-time for a qualifying employer for at least 10 years might not fit everyone's career plans. Plus, the program has been known for its complicated application process and high rejection rates, though many of these rejections are due to applicants not meeting the program's strict criteria. So, how does this apply to John and Sarah's situations, you might ask? Well, stick around as we dive deeper into their circumstances in the next scenes and shed light on how PSLF could potentially change their financial futures. In the world of public student loan forgiveness, or PSLF, understanding your repayment options is crucial. This brings us to two popular income-driven repayment plans: Pay, which stands for Pay As You Earn, and the new Save plan. Let's break these down. Pay, one of the first income-driven repayment plans, caps your monthly payments at 10% of your discretionary income. So let's say you make $100,000 a year, and you have a student loan balance of $100,000 as well. You would expect to pay $10,000 a year, or 10% of your yearly income. What happens if you make significantly more? What if you make $200,000 a year, but have a student loan of $100,000? Should you expect to pay $20,000 a year? Fortunately, there is a cap under Pay, meaning the most you could pay would be what the standard 10-year repayment plan is. So if you have $100,000 in debt, each year they would expect $10,000 in payment, regardless if you make more money, because there is a cap. So with Pay, the most you would have to pay would be equal to the standard repayment plan, in this case $10,000 a year. Now let's move on to the new Save plan. This program also takes 10% of your discretionary income, but with no cap. This means if your income significantly increases, your monthly payments could end up being higher than under the standard 10-year repayment plan. In the case above, if you make $200,000 a year, you would owe 10% of your income, or $20,000 a year. If you had a $100,000 in student loans, your standard repayment plan would be $10,000 a year. So for Save, your repayment is not capped, but Save has some unique advantages that may make sense for some borrowers. More on that later. It's also crucial to consider your tax status when choosing between these plans. If you're married, you'll need to decide whether to file your taxes jointly or separately, as this can significantly impact your monthly payments and the amount of loan forgiveness you might receive. So, what's the bottom line? Understanding these programs and how they work in relation to your personal financial situation is key to making the best decision. Remember, there's no one-size-fits-all solution when it comes to managing student loan debt. So take the time to weigh your options, perhaps consult a financial advisor, and choose the plan that best suits your needs and future plans. In the next scene, we'll delve deeper into how high debt-to-income ratios like John's can interact with PSLF. In this section, we explore the concept of public student loan forgiveness, or PSLF, using John, a recent medical school graduate, as an illustrative example. Despite having a respectable income, John grapples with a significant student loan debt, giving him a high debt-to-income ratio. This is where PSLF steps in to alleviate the burden for individuals like John. PSLF forgives the remaining balance of a borrower's direct loans after they've made 120 qualifying payments. That's 10 years of payments if you're following along. This can be a pivotal moment for John. Let's visualize this with a graph. On one end, we have the amount John would owe without PSLF, a figure that looms large over time. On the opposite end, we have the potential savings John could secure with PSLF. After a decade of consistent payments, his remaining debt is eradicated. The difference is stark, akin to contrasting a mountain with a molehill. Yet, it's crucial to acknowledge that PSLF does not magically erase debt. John must make those 120 qualifying payments, which necessitates him to work full-time for a qualifying employer, generally a government or non-profit organization. He must also annually certify his employment to ensure his payments are acknowledged by the PSLF program. For someone like John, with a high debt-to-income ratio, PSLF becomes an appealing choice. It can substantially alleviate his financial stress, allowing him to concentrate on his medical career without the oppressive weight of unmanageable student loan debt. Now, you may be thinking, what about individuals like Sarah, with a lower debt-to-income ratio? Let's delve into that in the following scene. Our focus now shifts to a different scenario. Let's say Sarah, a physician, has a low debt-to-income ratio. Unlike John, Sarah has significantly less student loan debt compared to her income. Does PSLF make sense for her? Visualize this. Due to her income, Sarah's monthly payments under an income-driven repayment plan would be substantial, almost on par with the 10-year standard repayment plan. Hence, she could pay off her loans in 10 years even without PSLF. But here's the catch. If Sarah seeks PSLF, she could potentially save a considerable amount of money. How? By making 120 qualifying payments, equivalent to 10 years, while employed by a qualifying employer, the remaining balance of her loan would be forgiven under the PSLF program. This means she could be free from her student loan debt after 10 years, the same as the standard plan, but possibly with a lower overall cost, especially if she was not earning as much money in her early years when working. However, potential drawbacks loom. The PSLF program demands Sarah to work in public service for the entire decade. A switch to a non-qualifying job would mean losing the benefit of loan forgiveness. Plus, potential changes in the PSLF program could impact her eligibility or benefits. So it all comes down to risk. Is it worth doing PSLF if having low debt-to-income ratio? That is a personal financial choice each person has to make. But definitely, if like John, and you have high debt-to-income ratio, PSLF typically makes the most sense. There are other ways to lower your payments for PSLF as well. That would involve how you file your taxes, especially if you are married. Now, let's turn our focus to Sarah. Sarah is in a marital relationship, but what sets her apart is her low debt-to-income ratio. If Sarah and her partner decide to file their taxes together, her monthly loan payments are elevated because student loans are calculated on your income. If you file as married jointly, then the monthly loan payments are calculated based on 10% of your combined income. However, if Sarah opts to file separately, there could be an opportunity to further lower her payments, as her income has lowered significantly since it does not include her partner's income. But just as in John's situation, Sarah and her partner must also evaluate the potential tax benefits they might give up by filing separately. As we can see, marital status and tax filing options can play significant roles when it comes to PSLF. Balancing loan payments, gaining from PSLF, and maximizing tax benefits can be quite delicate. The optimal choice is influenced by personal circumstances, which includes your debt-to-income ratio, your partner's income, and your total financial situation. PSLF isn't a solution for all. It's a financial tool catered to assist those with hefty student loan debts who serve in public service roles. Therefore, it's crucial to make wise decisions and possibly seek advice from a financial advisor or tax expert to fully comprehend all the ramifications. Could PSLF be the suitable choice for Sarah, and might it be for you? This is a question that deserves thought. It's about choosing the best financial decisions for your current and future situation. It's about comprehending the tools at your disposal and how to utilize them most effectively. With the introduction of the SAVE plan, the landscape of student loan forgiveness is being reshaped. It's essential to note the main difference between SAVE and PAY. With PAY, your monthly payment is capped at what the 10-year standard repayment is, while for SAVE, it is not capped. So, would you choose SAVE? Well, PAY is calculated based on 10% of your income, while SAVE is 5% for undergraduate loans and 10% of postgraduate loans. If you have some undergraduate and postgraduate loans, it is averaged out, giving you a rate somewhere between 5 to 10% depending on how much undergrad versus postgrad loans you have. So the main benefit of SAVE is that you could end up paying a significantly smaller monthly payment. However, the risk is if you earn a significant income, then you could be making a higher payment than the payee program, as there is no cap. As we conclude our conversation about PSLF, let's circle back to the essential points, particularly the impact of marital status on your repayment scheme in the context of the PSLF. As in, if you file jointly, it raises the amount of income you have, which consequently means you will pay 10% of that for student loans. The program's design caters those burdened with a high debt-to-income ratio, while individuals with a lower ratio might have other alternatives. The marital status plays a key role in your repayment plan, so it's critical to bear this in mind when applying. Regardless if you're a John or a Sarah, there's a light at the end of the tunnel for handling your student debt. It's crucial to examine all your options and always seek guidance from professionals.